Hello, welcome back. So this is Google's big earnings week, and for reference, this is my portfolio. So my largest single stock portfolio holding is actually Google. Google is currently at around 11% of the entire portfolio, so I'm quite bullish on Google overall. Google stock is down around 2% year to date. It is currently trading at around the 21 times earnings, and if you have to compare it to the average of the market, Google is actually extremely undervalued. So you have the market trading at around 27 to 28 times earnings, whereas Google is currently trading at a 20 times earnings. So relative to the market, Google is still extremely cheap, and that's why I still think it is one of the best buys in your market today. So for Google, this is their valuation. So Google's valuation is currently at a 20 times earnings, and this is a historical low relative to its history. So Google over the past few years has seen multiple contraction. In fact, it is currently trading at its lowest valuation point over the past few years. And typically when this happens, it is when you want to buy the stock. So when it comes to buying a stock, you typically want to buy a stock when the sentiments turn bad and when the earnings are still growing. So for Google in this case, Google's fundamentals have been growing consistently over the past few years, and yet the stock has been hammered over the past few months. So Google is still underperforming the S&P 500 over the past 12 months, and I expect that disparity to close soon because Google is a high quality company that will continually beat its earnings over the long run. So for Google, this is their earnings history. Over the past few quarters, Google has been massively outperforming the earnings that were being estimated. So over the past 8 quarters or so, Google has consistently beaten their EPS estimates. And for Google, the streets are expecting around 14% EPS growth this quarter, with a revenue growth of around 4%. So I expect Google to beat this quarter as well, although the estimates are a lot higher than what it was last year. So for Google Search, the dying portion of the business, Google Search is still growing revenues at around 12%. So for a dying business growing at around 12% revenue, re-accelerating from the low in 2023, I think it is the portion of the business that still remains strong. And with the AI overviews coming in, I expect this portion to still be strong in this quarter. So for the browser market share worldwide, as you can see, Google's browser market share actually dipped in around January of 2025 or so, and it is now back to all-time highs again. So while you're hearing all those people saying that ChatGPT is taking away Google's lunch, statistically, Google is still doing very well, and overall, this is bullish for Google. So for Google, the daily active users is also increasing. So despite ChatGPT, despite all your different other LLMs coming into the space, Google's daily active users is up 12% year on year globally. So in the US, it's up around 9% as well. So this is a fundamentally strong company that is still growing in terms of the daily active users. I mean, you would expect this sort of growth to be seen in companies like Meta, for example. But for Google, it is showing these kinds of numbers as well, signaling strong growth ahead. So for the company, besides that, their AI overviews and their AI products have been extremely strong. So for example, this is Gemini's new and returning users versus ChatGPT's new and returning users. As you can see, ChatGPT's growth has been slowing down as compared to Gemini, which is still growing quite massively. Although Gemini is still 1/4 of the size of ChatGPT, you can expect the gap to close up soon, especially with the investments into this portion of the business. So for Google, besides that, besides the Google search portion, the Google Cloud is growing massively as well. So Google Cloud is growing by upwards of 30% in terms of revenue. And when you have 30% revenue growth with exploding margin, that is when you see net income from the cloud portion growing massively. In fact, last year it grew by around 200% in terms of the operating income. This year it will probably grow massively as well. So if you're to compare Google Cloud's margin as compared to Azure and AWS, Azure's operating margin is at around 45%, AWS is at a 37%. So when you have Google Cloud's margin at around 17%, there's a massive runway for margin expansion ahead of it. So if you're to just play around with the numbers, if Google Cloud can grow to around 20-25% operating margin, that'll be an incredible increase in terms of the operating income for this segment of the business. So for YouTube as well, it is a juggernaut. So you have YouTube growing at 12% every single year. And for YouTube, it is a high quality business. And I believe it's the highest quality streaming company out there, better than other smaller companies like Twitch, which is owned by Amazon. Because YouTube has no content risk, there's no innovation risk, you don't have to continually come out with shows to pull in more users. You have your creators on your platform that is continually doing so already, as compared to Netflix, whereby they have to continually innovate to create new shows so that their subscriber count can keep growing. So for YouTube, I view it as a superior company as compared to Netflix. And for Google's valuation overall, if you're to do a sum by parts analysis, YouTube with subscription is around a 35 times EBIT. So if you're to assign a 20 times EBIT multiple, which is lower than Netflix EBIT multiple is around a 25 to 29 times. This gives you around a $700 billion market cap, for just the YouTube portion, which is around $56 per share. You have the cloud portion, which is around 20 times EBIT this year. So assuming a 16 times EBIT multiple similar to Azure and AWS, that will be around $320 billion market cap, which is around $26 a share. Then you have Waymo. The last round of funding was at around 45 billion. So Google owns around 40 billion worth, which is around $3.20 per share. I expect this Waymo portion to continually grow over the next few years. Waymo is still a wild card for Google. It could explode massively to the upside in terms of the valuation. I mean, when you have a company like Tesla that is valued at $1 trillion, Waymo could easily be a $200-300 billion market cap. And then the remaining portion, which is Search, is around $101 per share. That is estimated to be around 14 times price to earnings. So when you have Search growing at 10%, trading at around a 14 times earnings, I think that is more than reasonable for it. And that's why I'm still bullish on Google. So for Google, the summary is this. Google search will likely remain strong. If Google can report good earnings this quarter and over the next few quarters, then you'll see the narrative start shifting and we'll see a re-rating in terms of the multiple. They're still currently trading at a 20 times earnings, which is historically quite low in terms of the valuation. Google Cloud is growing rapidly and expanding margins. We could see upwards of 50% operating income growth from this segment over the next few years. And if you're to add Google Cloud as well as Google YouTube, it could easily become half of the business in the next 5 years and beyond. So for Google, I'm extremely bullish on this company. It is currently my largest position in my portfolio, so we'll have to see how they perform on Wednesday. The next portion I'll be talking about is some other important earnings as well. So you have other important earnings this week, and this is a massive earnings week. You have companies like Domino's reporting on Monday. You have Coke reporting on Tuesday, as well as Canadian National Railway, as well as MSCI, one of my holdings. On Wednesday, you have Tesla, Alphabet, Thermo Fisher, Pfizer V, CSX, IBM. On Thursday, you have a big semiconductor company, which is your Intel, as well as VeriSign, a very boring business. And then on Friday, you have your healthcare companies like HCA Healthcare, as well as Canteen, that will shed some light on how the insurance companies are doing this quarter. So let's talk about MSCI first. This is one of my holdings in my portfolio. So I have around 4% of my portfolio in MSCI. And for MSCI, it is a stable, predictable business. So if you were to look at their earnings history, they almost always beat earnings. I mean, the earnings are quite predictable. It is similar to a Visa and a MasterCard, where they don't move much in terms of the earnings. The only time where the stock dropped massively was because of the retention rate. They had a slight miss in terms of the retention rate, and coupled with the high valuation at that time, that caused the stock to drop around 20% in just a few days. Hopefully that comes soon so that I can deploy some of my cash into MSCI. So a lot of your ETFs outside of the US has actually outperformed the S&P 500. So for this quarter, I expect it to be a strong quarter for MSCI, and it'll be just any other day when it comes to MSCI's earnings. The next stock that I'll be talking about is Tesla. So Tesla year to date is down around 13%. It is currently trading at 181 times earnings. So for Tesla, their earnings history has been quite all over the place. The stock will miss earnings and then they'll beat earnings and then they'll miss earnings. So it's all over the place for this company. It is almost impossible for you to predict whether or not they will beat earnings. And for Tesla shareholder as a whole, I don't think they care too much about the earnings itself. What they'll care about is Elon's commentary on robo-taxis. That's the whole narrative for the company right now. And if you're to compare it to a company like Google, for example, Google's Waymo segment is actually a wildcard for the company. But for Tesla, it is a company that is solely reliant on this robo-taxi story playing out. So if the robo-taxi story fails, then this company will definitely take a beating in the next few years. So for Tesla, I view it as a company that is detached from its fundamentals. I will probably never invest in it. Like Elon Musk is definitely someone that you shouldn't be doubting. The next company is another company that is boring. So this company is up around 38% year to date. It has massively outperformed the S&P 500, and I've completely missed out on this company. In fact, when Warren Buffett bought into the company, I was looking at it, but I didn't expect so much multiple expansion in just 6 months. So this company is currently trading at a 34 times earnings. It is currently giving out a 1% dividend yield. So for VeriSign, it operates a very boring business. What they do is they sell your .com as well as your .net domains. They're basically a monopoly in the space, and no one is able to compete with them. But the problem with the business is they have limited pricing power, so they're quite reliant on volume increases because they have an agreement with this government agency, which is ICANN. They can't increase their prices for the first 2 years. They can only increase them at an average rate of around 7% in the last 4 years. So if you have to spread that out over a 6-year agreement for this company, it is around a 5% CAGR in terms of price increases. So for a company trading at 34 times earnings, growing 5% in terms of pricing, growing maybe 1 to 2% in terms of volume, and doing share buybacks of around 2 to 3%, you can expect around 9% growth for this company. I think at its current price of 34 times earnings, it is on an expensive side. Last portion, I'll be covering some of the questions left in the comment section. So the first one, it says, what do you think about Eli Lilly? The valuation is starting to look attractive. So for Eli Lilly, it is around flat year to date. It is currently trading at a 62 times earnings, around a 30 times forward earnings. So for Eli Lilly, it is the company that sells your Mounjaro drug. It is a competitor to your Ozempic. And Mounjaro has shown higher efficacy in terms of weight loss as compared to Ozempic. So that's a plus for the company. I think at the 30 times forward earnings, if you're betting on them being able to grow their weight loss drug sales, then I think a better buy would be to just buy into Novo Nordisk. It is a company that is half the valuation of this stock. In fact, this year, it is currently trading at a 17 times earnings, probably a 15 times forward earnings. But for Eli Lilly, it is definitely the higher quality company as compared to Novo Nordisk. Eli Lilly has a much stronger pipeline. There's a much broader suite of products as compared to Novo Nordisk that is solely reliant on your weight loss drug. So for Eli Lilly, I don't know much about this sector. It is an avoid for me. The next one, it says, what's your take on Bill Gates' portfolio? A bunch of real asset companies like Canadian Pacific, Waste Management, Caterpillar, as well as Berkshire, which are very different from MSCI, Moody's, MasterCard, these types of companies. Would you consider adding these real asset companies? To be honest, I don't see many reinvestment opportunities with these firms, and I'm also curious why Bill Ackman would invest in Canadian Pacific. So for all these real asset companies, they are extremely predictable companies. So for example, Canadian Pacific, they are the second largest railway company in Canada. So for all these asset companies, they have massively high barriers to entry. So for example, let's say if you were to talk about Canadian Pacific, it will cost billions and billions of dollars for a new company to come in and start building out all these rails. And even then, it doesn't make any economic sense for them to do so. And that's why Canadian Pacific is an extremely predictable business that will continually grow over the next few years. As for Waste Management, it is also another extremely predictable, recurring revenue business. So for all these different real asset companies, I think they are decent buys if you can catch them at the right price, but they're always trading at a premium relative to the market. For example, Waste Management has never dropped below a 20 to 25 times earnings. And so if you're able to catch them at a good price, I think they're good investments. As for growth opportunities, you don't need too much growth in your company as long as the price is right. I hope you guys have found this one useful and invest safe.